mercados. A continuación vamos a comentar esta escena internacional y para ello contamos con Jay Kaeppel, es Senior Research Analyst at Sentimentrader.com. Jay, thank you so much for having us a few minutes.
Thank you for having me on.
Well, today is the day D. Powell faces the inflationary spiral and the ghost of Volcker. The last time the Fed faced an inflation as high as it is today, in the early 80s, it raised interest rates to double-digit levels. And during this process caused a deep recession and a sharp rise in the unemployment rate. Do you think the US is facing the same risk now?
It's a different situation. I think there's so many more different factors. The big thing, of course, is $31 trillion in debt here in the U.S. As far as the Fed goes, we got the big day coming tomorrow, and everybody likes to guess what the Fed is going to do and how the market's going to react. One of the things, stepping back from the big picture, just in the short term, that I suggest for traders, especially in evaluating any kind of news, especially a Fed announcement, is not so much how the market reacts initially, but how it reacts after the initial reaction through the end of the day. So I'll give you an example. If the Fed comes out tomorrow and raises rates and the market gaps down because it doesn't like that news, for example, where does it go from there? In other words, if it keeps going down during the day, that tells us that the trend in the market is probably going to keep going lower. On the other hand, if you get a big announcement and the market gaps down and then starts to rally back by the end of the day, that's a different situation. It says that maybe the market is going to digest that news a little better. So that's kind of what I'm looking at. Doesn't really answer your question of the big picture. I'm not a big picture guy necessarily. I'm more of a trend follower. And so right now we seem to be trending towards a recession. So the big question is, how much of that recession has the stock market discounted? I have a chart I'd like to show, if you can bring that up, chart number 1. And this is for investors. Like I said, the trend, the old adage, the trend is your friend. And on that chart, it shows 4 different US averages. And all of them, if you look, there's a red line, and that is the 200-day moving average. Each index is below that long-term average, and those averages are trending lower. That is the textbook definition of a bear market and a downtrend. That doesn't mean the market can't rally. It just means if you are heavily in the stock market right now, you are fighting the trend. And just for example, the model that I follow right now is a little over 50% in cash, based primarily on that trend following. One last point on those charts, each of them you may see the black horizontal line that marks the June lows. So what I'm suggesting to people I talk to, investors, is keep a close eye on these 2 factors, because eventually one of these will be broken. Either price will break down below those black horizontal lines and we'll probably get another leg down in a bear market, or if those numbers do hold, then at some point the indexes, the averages, move above the red lines, the 200-day, and then we can start talking about some surprises and maybe a new bull market to the upside.
And Jay, what reaction can we expect from equity markets after Powell's announcement?
I really can't predict. Sometimes the market already anticipates what they're going to say. Everybody seems to agree that they're going to raise the rates 75 or 100 basis points. So I don't think that would come as a big surprise either way. And so, like I said, the real thing to watch is not so much how will the market react initially, it's how will the market react after that initial spasm, if you will, if there is one. That's really what to keep an eye on.
And we have following the 10-year US Treasury yields that jumped to their higher level in more than a decade before a Fed rate hike, and the yield curve remains inverted. Should we be worried? What are yields telling us from your point of view?
Yeah, well, interest rates, the bond market is what's really thrown a lot of people for a loop. And I have another chart. It's chart number 3, if you can bring that up. And basically, what most people don't know is that interest rates tend to move in very long cycles, 60 years, 30 years up, 30 years down. And if that chart is there, you can see interest rates, as you mentioned, peaked in double digits in the early 1980s. And then we had 38 or 40 years of downtrending interest rates. When interest rates go down, bond prices go up. And so for 40 years, people said foundations are the bedrock of my portfolio. And now in the last year, all of a sudden, if you look at the lower right-hand corner of that chart, you see rates have started moving higher. Higher interest rates mean lower bond prices, especially for long-term bonds. They're very susceptible. So at the moment, I'm looking at just at very short-term bonds. And the key thing to note in this chart is the interest rate has broken above its 10-year moving average, which has been a pretty good filter for keeping on the right side of the trend. So if history is a guide, what that means is we are now in the early stages of a long-term rising rate in trends. That doesn't mean it will play out that way, but for now, I advise caution in the bond market, either sticking to short maturities or floating rate bonds, but avoiding the long-term treasuries.
And what about the euro dollar? Which is, what do you think of the evolution of the pair? How do you see this evolution?
I'm sorry, can you say that again?
About the euro dollar, how do you see the evolution of the pair?
I'm sorry, I'm not following the question. I apologize.
No, don't mind. How do you see the evolution of the euro dollar?
Oh, okay. I'm with you now. The euro dollar, yes. It's very interesting, or the euro, yeah. There are a number of markets right now. Gold mining stocks, long-term treasury bonds, and the euro are all in just a massive free fall right now. And sometimes that's tempting to traders to say, wow, these things have to bounce at some point. And of course they will, but there's another old adage that says you don't really want to try to catch a falling safe. It's a great trick if it works, but it's fraught with peril. The thing I think investors should keep an eye on if they're looking at the euro is to look at the US dollar. So I have one other chart, number 4, which shows the US dollar index going back to the mid-80s. And the interesting thing to note in that chart is the US dollar index historically has spent very little time above the 110 price level. And that's exactly where it's at right now. And today, it's actually trying to break out to the upside. I'm telling people to keep a very close eye on the US dollar. It could keep running, but at some point, if you look at this chart, it just typically does not spend a lot of time above 110. And I think when the US dollar finally reverses, whether it's tomorrow or 6 months from now or whenever, that's going to change the dynamics a lot, because as the dollar has soared, stocks have gone down, bonds have gone down, and gold has essentially gone nowhere. And I think keep a close eye on that dollar. When the day comes that reverses, everything's going to change. So you want to keep an open mind because it can change very quickly.
Jay, thank you for bringing us these graphics, because they are very visual, and they help us to have a more accurate idea. One last question. Which investment opportunities do you see in the current market scenario?
Well, overall in the market, all I can tell you, instead of making predictions of what's going to happen, the real question for investors is how are you allocating your capital? And so just to give you a perspective, it's not a one-size-fits-all, it's just my own approach. I'm about 30% in U.S. stocks right now, mostly dividend-paying stocks, so that those are holding up fairly well. I have 5% in high yield bonds, which is kind of hanging by a thread. So we'll see where that goes. I have 10% in commodities, in commodity indexes. However, inflation seems to be trending lower, and commodities typically perform less well in the fourth quarter of the year. Little known seasonal fact. So that position may not last very long. And then I'm 55% in cash. So it's not a lot of fun these days for anybody, but it's nice to have a cash position to be able to not be losing and perhaps get back in someday when the time comes.
Jay Kaeppel, thank you so much. It's been a pleasure.
Thank you. Thanks.